Hi, everybody. My name's Pete Whitty, and I'm the lead analyst for Global PE here at EY. And you're listening to the PE Pulse miniseries on EY's NextWave Private Equity podcast. Our intention here is to give you a quick synopsis of the major themes and trends that are happening in private equity right now. What kind of market activity are we seeing, and what does that mean for you? In addition to today's podcast, we've got a great written report as well. And to read that, you can just visit ey.com/PE Pulse. Now, it's been an incredible first half of the year for PE, and we've got a lot to talk about. Huge rebounds from last year, records that are being broken left and right. You're just really seeing activity firing on all cylinders right now. So let's get started with our rundown. So we'll mix things up a little bit and we'll start with exits because it's really exit activity that's impacting a lot of what we're seeing in other parts of the PE lifecycle, especially when it comes to fundraising, which we'll talk about in just a minute. But the key thing to know is that exit activity has climbed substantially and PE firms are really exiting companies at a record pace right now. So for firms that wanted to monetize assets at the beginning of last year but couldn't because of the lockdowns, the wait for that is clearly over. And we've seen strong activities across all types, trade sales, sales to other private equity firms, even IPOs are back in earnest. And with respect to SPACs, now clearly everybody's heard a lot about SPACs over the last 6 months. And while that issuance has really wound down over the last few weeks, SPACs are going to be something that we continue to talk about in private equity, especially from an exits perspective, because you have this whole new group of buyers that has sort of materialized out of the ether over the last year. And they've got $180 billion in dry powder to spend. That equates to deals somewhere in the $700 to $800 billion range. And a lot of that money is flowing and will continue to flow to PE-backed companies. In the first half of this year, we've seen somewhere between 15 to 20% of PE-backed companies that were being exited go to SPACs. And, my gut says that's probably the right range. That's probably what we see for the foreseeable future. But I think overall, just a lot of tailwinds for the exits market right now. And that, of course, drives distributions to LPs. And that drives our next topic, which is fundraising. Fundraising is an area where last year we saw deal activity pick up in the second half. We saw exit activity resume. But fundraising never really saw that same kind of recovery. Up until 3 months ago, we were still down 14% on a year-over-year basis. And I think it's just because it wasn't really an area of focus, right? It was all hands on deck at most firms, putting out fires in the portfolio, doing everything virtually over Zoom made things difficult. It was just tough. But that's changed. Capital is now flowing back to LPs. People are able to travel in the US and Europe and Asia Pac. There's more comfort moving certain elements of the process over to virtual. And so we're seeing funds start to close again. PE funds raised more capital in the first half of this year than any other 6-month time period. And a lot of this was driven by the large fund complexes. Q2 in particular, we saw a lot of flagship funds closed. A lot of them were in the $10 billion plus range. And I think what's interesting is that even at that level of scale, a lot of these funds are closing very, very quickly. They're closing at much larger sizes than their predecessor funds. And in some cases, they're significantly oversubscribed. So it really paints a picture of strong demand from investors and to the softness that we've seen over the last 12 to 18 months or so. Now, with respect to deals, we've always sort of benchmarked deal activity against 2006, 2007, right before the financial crisis, when PE firms were announcing all of these really large deals. They were putting to work $700-800 billion a year. Well, that's finally been eclipsed. First half of this year, we saw more than $500 billion in deals announced globally by private equity firms. And just to put that in some context, as recently as, call it 3-4 years ago, that's what firms would announce for an entire year. And so that's a record, and it puts things on track, of course, for private equity's first $1 trillion year. And one of the reasons for that is that sponsors are announcing larger and larger deals. A few weeks ago, we saw the announcement of the second largest buyout in history, worth about $34 billion. But that's not the only one. We've seen several large deals valued at $10 billion or more. That's roughly consistent with what we saw back in late 2006, early 2007. And I think that's being driven by a few things. One, there's just this measure of increased certainty now that the pandemic is winding down. the continued low interest rate environment, the accumulation of dry powder that we've seen. When you look at pitch book numbers, private equity firms have about $1.3 trillion that they're holding on to that they can deploy. And so we're seeing them be much more aggressive in doing that. I think one of the other things that's starting to differentiate the post-pandemic period, apart from just the overall volume of activity, is that we're seeing the return of some of these club deal structures. After the crisis, we entered this period where firms sort of stepped away from some of the really large deals. And instead of teaming up with other private equity shops, they looked to LPs a lot of times. They partnered with corporates in some instances, family offices, sovereign wealth funds, and so on. LPs in particular have been increasing their capabilities in the co-invest space. So they've been an important source of capital for getting large deals done. But I think as we start to enter this new area of really large scale deals, there just aren't enough of these types of LPs that can write checks that are big enough. And so it's precipitating some of these collaborations between different firms. And so for some firms, I think just the scale itself is a differentiator, right? There's only so many firms out there that can write a $2 billion equity check for one deal, and then that also have the operational resources to support that company. So I would not be surprised if we saw a continued trend toward larger and larger deals, but then also more club arrangements. And in fact, I'm not willing to go out on a limb and say that this will happen for sure. But at the same time, I would not be surprised if over the next 12 months, we saw the largest PE deal ever. That would be something in the $50 billion range or so. So we'll see what happens. Now, from a sector perspective, I don't really know that the areas of focus have really changed all that much. Tech was important before the pandemic, and it's important now. Financials and insurance in particular was important before the pandemic. It's important now. Healthcare, maybe an increased focus there, but that was a top sector before COVID as well. What I do think has changed is perhaps the approach within certain sectors. Everybody has to figure out the effects of the pandemic and how that affects each company individually. And in particular, how valuations may have changed in light of COVID. What's interesting about the pandemic period is that while some firms made great investments last March, April, May, June, for the most part, valuations didn't really move all that much. The average LBO was done at a purchase multiple of about 11.5 times EBITDA last year. Some of these recent deals that we've seen have gone a lot higher than that. And you compare that with 2007, it was about 9.5 times EBITDA. And so for buyers, everything is just richly valued. And the challenge right now is really to figure out which companies are worth it. And to do that, you have to unwind the impacts of COVID. Some companies are seeing permanent demand increases because of it. There's the obvious ones like online education, telework, that sort of a thing. But there's also things out there that maybe aren't as apparent. In my neighborhood, for example, everybody who could put in a pool last year. And so if you make chemicals and accessories and so on for that kind of a thing, you're going to see a permanent increase in demand. And then beyond that, for some companies, there's been this pull forward in demand, which is temporary, but in some cases could have long-term implications for the future sales of the company. Think about all the people that went out and bought furniture and televisions, mattresses, all of this kind of stuff, right? And these products last a really long time. And so buyers have to understand what that shift in the demand curve looks like for each and every asset that they're looking at. And in some cases, it's going to take a really long time for the effects of that distortion to play out. And so firms have to have a very clear view of what that looks like. And that's one of the things that's clearly an area of focus right now. But overall, I think just a tremendous level of deal activity out there right now. I know a lot of you guys that are listening to this are seeing this every day. You're feeling this in your bones. So hopefully this helps give you some perspective and the knowledge that yes, things really are as busy and as active as they seem. So that's it for today. Thanks for listening. Don't forget to subscribe, and we'll be back next quarter with another update. Until then, take care.